My name is Dennis Ford. I'm actually the creator of the RESI conference. It came to me as an idea after spending a lot of time traveling the world going to partnering conferences. And I would go to partnering conferences and there would never be any investors at investor conferences. Maybe a couple of VCs with no money, maybe some corporate guys, maybe some angels, but really not a lot of investors. So what we've learned is that the old way of people raising money has changed. It used to be, go get some government grants, go get some friends and family money, find a VC, and hopefully get taken out by a pharma. We now have a whole new landscape, foundations, patient groups, hedge funds, family offices, private equity company from Asia, Europe. So there's a lot of action as far as the investor landscape goes. And the holy grail of the early stage investor landscape, of course, is the family office. And I'm really pleased today to introduce the panel. And I'll start with Hugo to my left and have him do an introduction.
Thank you. So I'm Hugo Perez, and I'm from Barcelona, Spain. I'm based out of San Francisco. My background is the family business, which is a 65-year-old company. I'm the fourth generation of the business. My father is still the president of the company. Salvat is a specialty company based in Barcelona, and we do have a family office that around our interest in some specific therapeutic areas that are in which we are involved at a company level. We explore in terms of being able to make investments. So we do have an arm that explores investments in biotech, and we also diversify into other spaces. That's my family business, family office background. I'm also an entrepreneur. Between 2010 and 2015, I lived in Shanghai, where I started a company called Luca Pharmaceuticals. Luca is a specialty pharma company doing marketing and sales in China and Hong Kong. And Luca raised a Series A for $15 million with Morningside Ventures last year. And following the closing of that round, I decided to start two new ventures in the US out of San Francisco, biotech companies based on technology for prevention of apoptosis. So that's my main focus now, but I am still very closely involved with the family office, and I do help identify opportunities to invest in biotech. So thank you for your attention today, and I'm happy to be here.
Thank you very much, Hugo. Ron?
Hi, I'm Ron Palivoda. I'm with Palivoda Group. We're a 20-year-old shop focusing on early stage investing. Within the health tech sector, we're looking at early stage companies focused on ways to reduce the cost of healthcare. But we're focusing on reducing the cost of healthcare to consumers so that out-of-pocket stuff that we in the United States have to pay, you guys in Canada probably don't. That's kind of what we're focusing on. 20 years, probably not 65 years over here, but we have a lot of experience built during that time frame, focusing on things like genotype diagnostics. For example, we look at using machine learning methodologies to read genomes and functional genomics. We also look at projects that look at biosensor data, what I call digital biomarkers. So trying to find patterns within biosensor signals that correlate with the progress of disease symptoms. And I'm glad to be here. Thanks.
Thank you very much. Sergey?
Hello everybody, this is David Topov. I'm a partner at NZ Ventures. So we are part of a family office. We have two offices. One is in New York. I personally live in New York, and we have an office in London. We headquartered from London. Within the NZ Ventures, we have two groups. One group is focusing on making investment in technology companies, and the second group is making investment in biotech companies. So my job, I'm focusing on biotech investments. So we have 10 companies under management at this point, and also obviously actively looking to invest in new companies. So let me answer again the question.
Thank you, Sergey. And last but not least, Sunil.
Yeah, my name is Sunil Salvi, and I am managing partner of a family office called Trellis Capital. And we invest in, actually we are sort of sector agnostic in the sense that we invest in any scalable business models that are highly capital efficient. That within the life sciences area, we typically have looked at and have played in the market with regards to digital health or healthcare IT, as well as medical devices. Our investment size is anywhere from 500,000 to, if you look at our website, it will say 2 million and up. So the up is a bit flexible. I think that we'll talk a lot more about flexibility and family offices. And we've been in business for the last 16 years, based here out of Toronto.
Great, well, thank you very much. Could I ask a question of the room? How many people are scientists, entrepreneurs, or fundraising CEOs in the audience? So that's interesting. Okay, Hugo, you've been in it for a while. Could you give me some of your ideas of how the investor early stage landscape has changed?
Well, I haven't been in it for as long as other people in the group, because I'm probably the youngest here. But I'll try to give you some insights. So I do think that it's changed, and actually I do think that there are two cities in the world that are much more advanced in the process of establishing that ecosystem for fundraising. One of them is Boston, the other one is San Francisco. And I think everybody is trying to replicate what we are seeing and what people have been able to do there in terms of fundraising and that process of moving from very experienced early stage investors into bigger VCs. I do see that in certain areas or regions, we are seeing how there's some growth of these business angel communities or groups, and also family offices that are entering into the space, very knowledgeable about the science and being able to add a lot of value into these startups. And that's what actually helps these early stage companies then be able to move into bigger rounds and to secure their valuations through their support, the strategic support that early stage investors can offer. So this is a trend that I think is happening in some cities, and the case of Barcelona is the one that I'm more familiar with. I think it also has the potential to happen here in Toronto and hopefully in other cities.
Thank you very much. Ron, do you have any commentary on like how the early stage investor landscape has changed?
I think that over the last, especially 10 years or so, we're seeing a lot more interest in the early stage from family offices like ours. And that has, I suppose, from an entrepreneur's perspective, good benefit. You're able to attract more funding. But I also think that there is another caution there in that it's tempting to take shortcuts in order to try to meet valuations, expected valuations that were instituted early on. I won't point fingers or name any names, but a certain company out in California whose name starts with a T has recently experienced some challenges, primarily because they were not cognizant or willing to accommodate much longer time frames of return on investment. So that's one of those interesting dynamics where there's a lot more capital that is being provided to entrepreneurs, but there's also a dark side associated with it. So that's, I think, some of the more salient changes I've seen in the last 10, 15 years.
Sergey, we're from Boston, we're on the coast, so we like to go fishing a lot. The season's coming up. And we say if you want to catch a fish, you have to think like one. How do you think like a family office if you're a fundraising CEO? What does a family office look like as far as how you evaluate, how you vet, what do you look for when you're looking for an early stage investment?
Well, again, I mean, obviously we are part of a family office, we have one LP, but actually we do kind of structure our activities as a standard, pretty much standard venture capital group. So we have pretty much standard model. We invest and sell companies and make money. So in that respect, what we are looking for, I think, is probably pretty much universal across every single venture group. So we are looking for a great company with good technology, but most importantly, a company that has good management. So again, we are very realistic in that respect. We understand that startups will be probably founded mostly by scientists guys, not necessarily by people that are experienced in managing mid-stage, late-stage companies. That we, as investors, obviously we get in early, but we understand that our capital that we provide to a company is to drive company to mid-stage and later-stage clinical development. So we would like to work with the management from the day one, and so they understand that at the right time we may need to bring some changes so that we will actually benefit current management as well as current future investors. So also from if we are talking about the valuation, so obviously we live in the real world. When we started ENSA about 6 years ago, so the valuation there was zero. There was almost no IPO market in the United States. So an M&A market was also big pharma would not necessarily pay $1 billion upfront for technology. So that was kind of tough times for venture, I guess. So we were in that respect lucky, so we could find later stage deals, which kind of obviously less riskier. That the valuation was pretty much would be a pretty preclinical stage company if you look at it right now, because right now obviously early stage companies and mid-stage companies, the valuations are tough, so you have to find the right technology, the right valuation at the end of the day to make money. So we would focus on obviously right now early stage. Valuation-wise, it is more difficult obviously to argue a lesser valuation, but it doesn't make any sense to bring a company, to invest in a company with a higher valuation which doesn't have any data, because down the road you will be having trouble bringing more money into this company, and everybody gets down around, to be honest. So,
Quick question, how many folks come at you a week or month that want your attention? How many early stage companies are sending you emails or giving you phone calls? What's the number?
a week.
A week.
Well, it depending on the day. I guess Monday after the weekend there are more emails. So on Friday people would like to take a long weekend, so especially scientists. So when we would probably have about 10 to 15 companies, I think on average. Yes, I mean it's kind of all sorts of companies. I'm not saying that these are the companies I would be actually followed on, but yes, it's there's a lot of deals, because again this is the best time for biotech. There's so much money in biotech, so there are a lot. It actually creates a lot of new ideas that can be funded one way or another.
So my first comment here would be that I have the feeling, and for what I've seen, family offices in the U.S. or North America in general are much more structured and more professional in the way they look at deals and they explore investment opportunities. I think we're less professional in Europe in general, and we also have we have to also act at a smaller scale. But because in our particular case we don't proactively look at opportunities, or we don't present ourselves out as a potential investor for biotech opportunities. People reach out to us because they know that we are either investors in another company in the region, or because they've come across somebody from our team that they've met. So I would say that we get around 2 or 3 deals a week in the biotech space, and that's, and most of them, I would say 75% of those opportunities come from Spain actually.
Okay.
Because that's the region where we are more active.
So it sounds like anywhere from 10 to 50 a month. which is a lot. Ron, can you tell me a little bit about the quality of the people that are coming at you? Are the presentations up to snuff? Is there any consistency? Is it all over the map? What do you want to see?
Well, since there's many more earlier stage companies approaching us nowadays, we see certain deficiencies in pitch decks. These tend to be teams that are less experienced earlier, maybe out of school or just PhD level. And that actually poses a challenge and a frustration to those who submit pitches to us. There needs to be certain criteria within your pitch deck that you need to meet before it gets past the gatekeepers in our shop, into the decision makers. And if you don't meet certain criteria, we never see your pitch. So that's kind of frustrating to many novice, first-time entrepreneurs. But simple things. What is the value proposition that you're offering? Not necessarily to the status quo, but how does it differ from the competition? And a lot of folks show me things that perhaps improve their business process or a product, but they need to distinguish themselves from the peer competition. Experienced management teams tend to recognize that and highlight that in their presentation. Less experienced teams tend to bury it, and we try to go in and dig through it, but we only have X amount of minutes per presentation to kind of extract that information. Now, if you're doing your own pitch decks, stop it, okay? Hire somebody who's experienced. Read the book. I liken it to a haircut. You can give yourself your own haircut, but just because you could doesn't necessarily mean you should. Okay? It would avoid, yes, it costs money, and I understand that early on you have certain budgetary constraints, but it's one of those things that really distinguishes your offering from others that we receive on a weekly, monthly basis. And we receive a lot. In addition to receiving new opportunities, we also receive updates on things that we're tracking. So on a, I don't know on a weekly basis how many we see, but annually, it's in the many hundreds, if not thousands, of updates and new opportunities. So there's a lot of competition out there, and you need to find ways to distinguish yourself. Value proposition is one. Also, data-driven conclusions. Just because you state something doesn't necessarily make it so. You got to have some data behind your statement. And we tend to focus on that. If you cannot support your statement with data, don't make it. Don't give me 250 pages in your deck. Focus on the key aspects for your message. The team is important. Nine out of 10 projects fail. But what we look for is not just the product or the solution that you're proposing, but the team itself. Because we tend to recycle team members into other projects. So if you have a good, robust team in your project, we take that into consideration. That's important.
So that's great. So now presentation is important. Team is important. Sunil, could you just talk about relationships then? So it sounds like if you're going to get an investment, it's a marriage. It's going to be a long-term marriage. And it's not just the data. It's not just the thesis of the company. It's the relationship with the
I think Sergey and I were just talking about that, which is, I think in this business, whether you're part of a family office or you're part of an institutional fund or an angel VC or an angel investor, at the end of the day, many of our deals have been done based on an entrepreneur, a management team who has floated their idea or their business proposition way before it actually took root for them to come to you for money. So I think it does. People like to do business with people they know and they like on both sides, from the entrepreneur side as well as from the investor side. And I do emphasize it has to be both sides. And therefore, a lot of these things build up that relationship so that by the time the money is having to flow or the decision is having to be made about an investment, you're already a known entity. You're already someone who, as an investor from our side, is familiar with sort of what are the pluses and minuses. And so therefore it becomes much easier, and biases do creep in. That's what we all are, as human beings. So that's the reality of it. So if I was an entrepreneur,
So you're not investing in just the data, you're investing in the relationship with the CEO and the team.
exactly.
Is there a difference in approach that a family office would take as opposed to another source of financing? Like, I know this session is about the family office, and how would you distinguish your approach versus either an angel or a VC?
So to your point about the team, I do think that the team is especially important for a family office, more so than for a venture capital firm. Usually venture capital firms have the resources to support the team or to identify additional members to the team. When you're a family office, you're basically relying on that entrepreneur that is going to take over a project, that's going to take your money and is going to make your money run. So, and you expect that business, the business model or the business plan is going to change over time. So you expect to be committed to somebody or give the money to somebody who's going to be able to evolve that business model whenever things don't go the way they are expected to go, which is usually what happens when you're working on a biotech or a startup company in general.
Yeah.
Can I just respond to that? I might have a bit of a different approach to that, and I think it may be, Hugo, you're lucky enough that you've got a lot of money for you. It's a little bit different. I'm a hired gun, and therefore, when the family whose money I manage, they took me because of the sort of quote-unquote professional sort of discipline I brought to the table from my previous institutional fund that I was part of. So in our case at least, and I would say that there are certain fundamental principles that have to be followed regardless of whether you're a family office or not. It's all about what, we are very hands-on investors, so we are not that fussed about a complete management team. We do want an entrepreneur who's driven and who knows, has domain expertise, a track record if that's what they have. But at the end of the day, it comes to the fundamental things that Ron was talking about, which is there fundamentally a good value proposition from a customer standpoint? Is there a differentiator that you've got that is sustainable at least for a certain period of time that you can create a real opportunity out of? So I would, I think if you're managing your own money, and I could see that even with the family whose money I manage, if they were making the decisions, it can be much more informal, and then they are backing someone who is playing that role that maybe I'm doing for them, which is being that professional manager that can make those kinds of decisions.
Let's go back into the audience. We have one here.
Thank you very much. I'd like to just go back to what you were saying about relationships, and I'm curious as an entrepreneur, how does an entrepreneur find the right family office to be talking to? How are you finding your entrepreneurs? And I got a little bit of a sense that people are just firing in your pitch decks. Are you depending on referrals, or what's the beginning, very first step of that relationship?
I can go first, but again, so when you putting together a presentation, so it is best that you kind of do your homework and see who from family office or venture group invested in similar projects, because those are the guys who probably have most interest. But if I've never invested in like devices space, I think no matter what device you send my way, I'm probably not going to be interested. Same if it's like we, for instance, invest in therapeutics. So there's certain spaces you already invested and I'm actually made money, so we feel good about those spaces. So this is going to be, I think, will be your kind of audience that you send me a presentation my way, which kind of reflects the work we've done in the past. So I have the interest in doing so. So I would most likely review your deck. Also, you probably will, you can kind of tell from, obviously we have all websites and release companies we invest. You can track syndicate members that work with us. And so those guys also, if you send presentation to me and send presentations to other venture groups we work with, so you kind of yourself will pre-select that syndicate for yourself. And maybe I will not respond to you, but someone else from the syndicate I work with respond. So it's kind of a number game. The more you send them, probably better chance people will respond to you. And then those guys will talk to me, let's say, oh, we came across that great company, so now maybe like talking to them about your company, or I might have ignored or just kind of never opened the email. Sometimes it happens actually. It's bad to open every single email, but it could happen. So yeah, so I think you should be proactive about it and just find someone that kind of.
So one of the things that I'm hearing is I go to a lot of incubators around the country, and everybody's got the Excel spreadsheet that they got from their friend, who got it from their friend, who got it from their friend. And it's just an Excel spreadsheet with a name and an email, or whether it's a VC or a family office. And then people just spam whoever's on that email list. They don't do any research. So, you know, if you're just spamming people and you don't know who you're going after, you have an oncology therapeutic and you're going after some guy that is a medical device guy, you're just creating white noise. And so if you multiply this room times every other room in North America, and you're just taking Excel spreadsheets and just spamming everybody, it's really, really difficult. But I think the point that Sergey was making is that if you're really serious about learning about how to get the money from the family office, go to Google, research them, go to their website, research them. You can find a lot of information. By doing that, you're going to be informed, and by being informed, when you reach out, you're going to say something. So, you know, we have a database that we sell at Life Science Nation. It's 5,000 global early stage investors that we curate. We have 7 full-time staff that curate that database. And so when you look at a profile in our database, it says who they invested in and who's the guy you got to call and, you know, what they like to see, versus an Excel spreadsheet that you're just loading into, you know, some chimp mail and just sending it out. So I think it's really important to do that.
So my question is, as a startup seeking capital, how do I become aware or get to know which are the family offices that are investing in my space?
The best way to get to a family office or any venture capital is through referral. And the best way to get a referral is to network. Events like this. You may have local events in your community that you need to attend. You can't just wake up one day and expect to know which shop is interested in the sector you're in and raising a fund early stage, et cetera, et cetera, et cetera. You got to do the homework. So part of the challenge as an early stage company looking for funding is to bring on board somebody who actually knows investor relations. It's not something that a scientist focusing on the technology can easily balance day to day. You really have to bring somebody on board who focus on attracting capital, somebody who can focus on communicating challenges, successes to prospective investors. So that needs to be part of the thought process when you're creating a hopefully sustainable organization.
And I would say there's also nothing wrong with hiring a professional that has already established their network and can help you out and understand who you have to talk to, and they're familiar with that process. I'm sure.
Yeah, go ahead, sir.
I mean, you guys do help startups identify the pool of potential investors and every region, in every city, you will find somebody who knows who are the local investors and how to approach them, and they probably will have the direct connection. So I think a face-to-face introduction is the first step into talking to mainly family offices. I think for RESI it's probably a little easier because they are used to, their websites are out there and they are used to receiving a lot of emails and decks every week, but for family offices it's probably the personal connection.
You know, so
Can the panel comment on any potential, any perception of a company that comes to you on their own versus a company that is being represented by an agent? I've heard that a company should be cautious about hiring an agent because it shows weakness, that you need somebody else to help you raise the money for you. Is that true in your eyes, and perhaps you can comment on that?
I mean, of course, you're going to want to meet the CEO after you get the introduction. So I think once you meet the CEO, you're going to know whether they are weak or not. So I wouldn't be too concerned about getting that first introduction. And it would actually make me comfortable. If I already knew that the person who was making the introduction, that would be even better because that's a positive.
Yeah, I think it's also dependent on the agent. Some of the groups you kind of trust, you would open the emails, and some of the guys you just stop opening the emails, just trash them right away. And that's actually, it just happens naturally. It's just like some of the agents, they don't really care about us and kind of wasting our time. Like, for instance, there's so many times I said, like, we do not invest in public companies. Those guys keep sending me public companies. So first I was really impatient about that. And then I just like delete all the messages I get from this agent. But, you know, there's some agents that are really diligent, so they know us well. And we don't mind working with them, but obviously we need to talk to see.
Two questions. Number one, what's the general timeline that you guys expect an exit as a family office? And number two, do you guys see yourselves primarily, and this probably depends on the family office, as a strategic investment or strategic partner for these companies, or purely financial investors?
We only invest in companies that add value to our existing portfolio. So there needs to be an alignment. So it's really like a corporate venture capital, the way that we approach it. As far as exits are concerned, I look disfavorably upon companies who are building their systems so they will be bought out. Why? Because if what you're building is an exit ramp, you're not really investing in innovation. Companies who don't expect an exit, but expect to fight it out in a marketplace for a longer period of time, tend to invest more in innovation and longer term thinking. An exit is not guaranteed. What happens if you don't get an exit? You're screwed. So we never consider an exit as, if you're building something with an exit in mind, that's short-term thinking. That's not what we like to see.
we had some questions, okay, over there.
How do you manage how much should be raised? What do you expect your ownership is going to be by the time you exit? How do you manage that process and think about it?
It depends on, it's a case-by-case issue. We want to be cash efficient, and we look at a relationship over a longer period of time. The health tech fund is an evergreen fund, so it's tied to the balance sheet. It's never going to run out of money. So we're always going to be available to provide additional capital as needed. As far as looking at what other people were able to raise, $80 to $100 million, that's their problem. Okay, don't make it your problem. You haven't seen the term sheet. There's a lot of stuff happening in the term sheet that also should be considered, not just the value. So when you see something on CNBC or wherever, this company raised X in this valuation, so what? It's meaningless. Do what's right for you, and that's on a case-by-case basis.
Yes.
Data question for gatekeeping. Do we need to have peer-reviewed data to get past the gate? I mean, peer-reviewed publication, or can we just have data? Because the peer-reviewed publication is a pain in the ass, it slows us down.
So I'm supposed to trust what you think?
It's a technical expert look at it. You're going to do due diligence on it anyway, right?
The issue is not the due diligence, the issue is gatekeeping. And you want to, and if you're saying, well, you know, we did an internal study that found X, that is not as strong an argument as if we have something out of NIH or some Harvard or wherever that you've collaborated on, and you have interesting results coming from. That's much better.
Okay, this gentleman over here.
Yeah, syndication question. What type of other partners do you like to syndicate with?
Great question.
Do you syndicate with angels or VCs, or what's your ideal mix?
And for our group, we never syndicate with angels, so we always syndicate with venture capital firms. Because again, we understand that we invest in therapeutics only, so it's different from diagnostics and medical devices, at least for the development stage. So we know pretty much how much money we actually need to bring a company to a point that is sellable via M&A, or we need to bring a company like IPO. So we want to make sure that we are not going to be the only group that finances a company, and that's why when we invest, so we put X amount of money, and then we reserve 3X of that for following rounds. We expect members of our syndicate to do the same, so at least to put on right investments, because you don't really want to go down the line and all of a sudden see a fund run out of money, and then you have to bring extra guys in the CEO now spending time instead of running the company to become a fundraiser, so it will take a year to do that. So that's obviously an ideal situation to have a well-formed venture syndicate with deep pockets. For angels, not because we don't like them, but their strategy is different, right? They invest usually once and they don't really come and get your multi-million-dollar checks.
Sunil, what about you in syndication?
Yeah, I would just say that I think alignment between the syndicate is extremely important. So, you know, we've invested, co-invested with angels, we've co-invested with VCs, our other VCs, we've co-invested with corporates, and each one has their own objective. And I think whoever's the lead, and we typically have led deals, so we've had an opportunity to therefore work with the entrepreneur, the management team, to ensure that whoever's coming to the table is there because not just of the money, because of the money. Corporates, you know, you need to make sure that it's always a double-edged sword. They bring a lot of strategic value, but are you becoming captive to them? You know, so the ones we worked with, yeah, they are as good as, you know, in terms of not having any special rights of first refusal and all of that good stuff. So it really becomes an alignment of, you know, of objective. At least, and I'll speak in the Canadian construct, you know, angels here have evolved over the last 10, 15 years or more. Way more sophisticated, lots more dollars to play with, lots more understanding that you need to keep powder dry, because if you're going to play with, you know, deeper pockets, then you need to be at the table through it, because everything doesn't just go up and up. You're going to have maybe down rounds and all of that good stuff. So.
Yeah, so when we actually look, you know, we have probably like 500 or 600 fundraising CEOs that we've worked with. So we always tell them it's going to be a 9 to 18 month process. You know, look at the worst case, not the best case. We've seen people get funded in 6 weeks. We've seen people get funded in 6 months. But if you're going to plan it, you want to plan it right, because if you're getting a little bit of money and then you spend 12 months getting it, then you go spend it in 9 months, and now you have to go re-up that again. So you really, you know, is it better to look at 24 or 36 months out? What do you need? And then if you can get a syndicate of players that can crunch the money out for you, it can be a lot more compelling. I think we're kind of nearing the, we've neared the end. This was great. I didn't even have to moderate the panel. You guys asked all the questions. So thank you very much. We appreciate the time.